I'm Carly. Welcome back to our series of financial education for women. Last time we talked about employer-sponsored plans and kind of touched on the topic of traditional versus Roth, and today we'll be continuing that conversation. So the main difference is when you pay taxes. So in a traditional IRA, you're going to pay taxes later, you're going to defer your taxes, and you can also deduct your contributions. In a Roth, you cannot deduct any contributions, and you will also pay your taxes now, so then all of your earnings will grow tax-free. Okay, so now we'll talk about tax treatment of withdrawals. For a traditional IRA, because you did not pay taxes yet, all of those withdrawals will be taxed as ordinary income. On the other hand, for a Roth, because those taxes were already paid, as long as it's a qualified account and a withdrawal, that means that the account's been open for at least 5 years and you're over 59 and a half, then you will not be taxed on that withdrawal. One thing to consider is if you have a traditional IRA is that every account holder that is over 73 will have an RMD, which is a required minimum distribution from that account every year after they turn age 73. And this RMD is going to be based off their life expectancy factor and the account balance from December 31st of the previous year. A Roth does not have any RMD, only traditional IRAs do. Okay, so in summary, a traditional IRA would be best for those wanting an upfront tax deduction now if your income is high, and a Roth would be best if you're expecting higher tax rates later or if you want tax-free income in retirement.